consumers are saying that they're looking at politics in general as something that will impact the economy. But when we pull out the measure, or at least the tracking with respect to the election itself, we're not seeing consumers paying that much attention just yet. And usually that ramps up very close to the election.
You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Markus Schomer, Senior Economist with the Conference Board and guest of today's episode. In today's conversation, we'll discuss the latest U.S. Consumer Confidence Index, as well as our outlook for the global economy. Joining me today is Dana Peterson, Chief Economist and Leader of the Economy, Strategy and Finance Center here at the Conference Board. Welcome, Dana.
Good morning, Marcus.
Dana, what was the biggest takeaway from the July Consumer Confidence Survey?
The biggest takeaway is that consumers in the U.S. are still having mixed opinions about the economy. On the one hand, they are saying, yes, we're working, that's great, but they're still very much concerned about inflation and also the price level of goods and services. They're also quite concerned about interest rates being elevated, and they're starting to say more things about the impact of politics on the economy.
Interesting. Were there any other write-in comments of note?
Yeah, so in terms of the write-ins, again, there was a lot of focus on the price of goods and services, especially food and energy. And they were also still very concerned about inflation. Inflation is the rate of change in the price of goods and services. While we're seeing fewer write-ins about the pace at which prices are rising, consumers still believe that many prices are still quite elevated. When it comes to the labor market, we're starting to see more consumers say that the labor market is potentially going to affect the economy. And that's notable because when we look at the labor market, it's kind of downshifted, but from raging to what we would call robust. We still see the unemployment's quite low, and we still have a sizable number of payrolls. But nonetheless, consumers are thinking that there's something concerning or disconcerting about the labor market. And then finally, in terms of write-ins about the upcoming election, overall consumers are saying that they're looking at politics in general as something that will impact the economy. But when we pull out the measure, or at least the tracking with respect to the election itself, we're not seeing consumers paying that much attention just yet. And usually that ramps up very close to the election.
Coming back to the July survey itself, what caused the movement in the overall measure this month?
Sure. Well, this time it was expectations. Expectations ticked upward, but really they were just still negative. So they were less negative. And certainly when we look at the components of the expectations measure, the components include income, expectations for income, businesses, and employment. And while income remained positive, the balance in terms of expectations about employment and businesses remained negative. It was just slightly less negative. So that moved the overall consumer confidence measure. However, when you look at the present situation is starting to slide, and we've seen general direction downward. And that's mainly because of less certainty about employment in the short run. But even still, the employment picture for consumers is positive. But again, I think it's slipping in terms of what they think employment will look like going forward.
That was very detailed about the drivers of the present situation and expectations measure. Were there any other differentiation by age or income, for example?
Sure. So we look at age and income on a 6-month moving average basis because the measures are quite volatile month to month. So when we look at that, for the most part, people who were under 35 and people over 55 were more optimistic in the month, again on the 6-month moving average, than people in the middle, people 35 through 54. And certainly people 35 through 54, when we look at measures of debt, those are the people who have most of the debt. So those are your Generation X folks and also your older millennials. And so we're seeing them pile on a lot of consumer debt, as well as many of them still have student loans. So that may lend to some of the reason why that group is feeling constrained somehow right now, as well as the fact that this is also the group that spends the most money. and certainly prices are elevated and interest rates are high, especially for big ticket items. In terms of income, we're not really seeing much in terms of a clear pattern. It's really all over the place month to month. And on a 6-month moving average basis, consumers making more than $100,000 per year are more confident. However, the gap between them and other consumers is shrinking. So they're kind of coming downward in terms of their general degree of happiness to where everyone else is.
Fascinating. And I know we also track the question about recession. What are consumers saying about the likelihood of a recession right now?
Sure. So as you know, our recession measure was started back in July of 2022. So we really we exactly have 2 years worth of information. So we don't really know what the low is, but certainly the high was back in May 2023. And certainly the July 2024 number is much lower than that. It did tick up a little bit from June to July, but still in all, I would say consumers are largely not anticipating a recession. But I do think they believe that the U.S. economy will slow. And we believe this is fairly consistent with what CEOs are saying about the U.S. economy, where most of them do not anticipate a recession at any point, but certainly the economy could slow. And then finally, when we look at our leading indicator for the U.S., it's been negative on a year-on-year basis. But even that is not necessarily signaling recession. We think it is signaling slower economic growth going forward relative to what we saw, certainly the robustness in 2023.
If you look forward a little bit, how do consumers view the future of inflation, interest rates, and the stock market, the things that drive consumer confidence going forward?
Sure. Let's start with inflation. So we do have the 1-year inflation expectations measure, and that was unchanged at 5.2%. Now, it doesn't mean consumers think inflation a year from now is going to be 5.2%. It's really a relative measure, and it continues to decline from the peak that we saw a couple of years ago. And that's good news. It means that consumers are seeing the fact that prices are rising less rapidly. But again, the bigger concern is about the price level. They're saying, well, groceries are much higher. I'm paying $100 more now than I was a year ago. So the good news is that they are recognizing that overall inflation gauges, and certainly we've seen that with the CPI and the PCE deflator, that they are slowing on a year-on-year basis, but prices are still too high. When it comes to interest rates in the stock market, consumers for a while were thinking that interest rates were going to continue to rise. That sentiment is reversed. They're expecting that, yes, interest rates probably about 12 months from now, will be lower. And that's consistent with what we expect, and I think most economists are anticipating for the Fed funds rate. It's going to be lower than it is now. But again, I think it will land at a place that it's probably higher than what we saw during the period between the Great Financial Crisis and the pandemic. And finally, the stock market. In our latest reading, consumers were still very excited about the stock market. And that's important because if consumers believe that the stock market is doing well, they tend to internalize that and believe, well, that means my company is going to do well, and the likelihood that I will still have a job is good. And also some consumers are benefiting from it in terms of their 401k plans and their portfolios. But again, the stock market doesn't always reflect what's going on in the real economy, especially when you have a subset of stocks that are really driving things. And even the last week, we've seen the stock market come off, again, because this subset is letting some steam off. But I think for the most part, consumers are still positive about the current economic situation with respect to the labor market, but again, seeing some issues going forward.
How do consumers feel about their finances? And that again captures, of course, employment and inflation themes.
Yes, it's interesting. So we asked several questions. One, we do ask about income. So income is what you're getting, right? So either from work or from your financial assets or from government transfers. Finances is kind of your overall situation. So that includes your income, whatever savings you have, and also are you able to buy the things that you need and want. And for the most part, both in the current situation and also looking forward, consumers have been a little less optimistic about their financial situations. And I think, again, that reflects the fact that even though consumers are working, they're receiving incomes, many of them did see increases in their wages over the last few years, prices are still high. So a lot of their pricing power, their spending power has been eroded by elevated inflation. So I think that's what we're seeing reflected here.
What are consumers' buying plans regarding durable goods?
Yes, so we look at a number of things, including the desire to buy houses, new and used cars, appliances, and also electronics. So we also look at that over a 6-month moving average basis because the data tend to be very volatile. And it is still the case that consumers are less likely to desire to buy a home over the next 6 months. Also, with respect to durable goods, they're still a little antsy about buying a car. Now, we did see appliances pick up, which is interesting. It could be the case that many people are seeing their appliances break down, but it's not necessarily the case that they're buying these appliances to put in homes, as we see not only in the actual data where home sales are pretty weak, both for new and existing sales, but also in terms of sentiment, consumers are not that excited. But when it comes to, I would say, appliances and also electronics, consumers are, as I said, they're excited about buying appliances, and they're also looking to buy laptops and PCs. Other types of electronics are not terribly interested in purchasing right now. But I would say that this is somewhat consistent with what we're seeing in services, where consumers are trying to figure out ways to entertain themselves less expensively. So, for example, you might stream at home rather than go to the movies. So that's why we're seeing pretty strong demand, we think, for laptops and computers, but not so much for buying televisions, which is also something we track.
What about broader services? You already mentioned some services connected to durable goods, but services spending is the bigger part of consumer spending overall. So what does the survey tell us about service spending?
Yes, so at least twice a year, we ask consumers about what they plan on spending more or less on with regards to services. It's still the case, or rather it's increasingly the case, that consumers are focused on purchasing services that they view as necessary. So, for example, healthcare or auto insurance, and even things like streaming and internet relative to highly discretionary items like gambling or going to the amusement parks or hotels or movie theaters. So that's certainly still the case. And when I look at the types of services they're buying, they're also downgrading, they're downshifting. And we're seeing that also for goods where people are purchasing the store brand. But with services, they're opting for the lesser, the least expensive types of ways to either buy food or entertain themselves.
So if you put this all together, Dana, what did you deduce from all this for the outlook for household spending this year in the U.S.?
Yes, it's been difficult to tell because there's a lot of volatility from quarter to quarter. So certainly in the first quarter of this year, we saw that goods spending was negative, and it was also negative in the fourth quarter of last year. And then we saw a pop in the second quarter in goods spending. And again, I think that's because the prices for things like furniture and cars actually have been declining on a year-on-year basis. So there's deflation for those goods, and potentially people jumped in and bought those things. However, when we look at services had been very strong in the fourth quarter of last year and the first quarter of this year. But in the second quarter, they kind of shrunk. And again, we're seeing this rotation that consumers have been talking about in terms of their sentiment. We're seeing it show up in the raw data, where they're shifting away from wants to needs and purchasing these less expensive types of services. So looking forward, it's really tough to tell. We don't have much in the way of retail sales yet, but I think consumers are definitely feeling the weight of elevated interest rates. And in general, I think that pop we saw in goods spending in the second quarter may not be reversed going forward, because until the Fed starts actively cutting interest rates. When it comes to residential investment and the desire of consumers to purchase homes, I think the Fed just has to signal that they're ready to cut interest rates, and mortgage rates will come off, and then that will provide relief for anyone who's looking to purchase a home or even sell a home in terms of those mortgage rates being lower, especially since the price of homes continues to rise. So once the Fed, again, signals that, maybe at tomorrow's meeting, the July meeting, or even at the September meeting, you'll see some relief and some pickup in residential investment. In terms of services, again, I think we're going to continue to see this rotation. And certainly in general, consumers are feeling burdened. We're seeing more consumers paying for their goods and their services using credit cards, and those credit card debts are rising. And also we're seeing lots of delinquencies, certainly through the first quarter of this year. And soon we should see the data on the second quarter. So that's not a really good story for consumers. But the good news is, again, most consumers are working. So there is income coming in, but they are feeling the pinch of inflation being still elevated, interest rates not being much lower than they are probably over the next year, and also the fact that there's quite a bit of debt piling up.
A fascinating deep dive into the state of the U.S. consumer. We're going to take a short break here, and we'll be right back with more of my conversation with Dana Peterson.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm your host, Markus Schomer, Senior Economist with the Conference Board. I'm joined by Dana Peterson, the Chief Economist and leader of the Economy, Strategy and Finance Center here at the Conference Board. Dana, let's broaden out the conversation a little bit. What is your outlook for the global economy this year?
Sure. So the outlook is for roughly 3% growth. So last year, the global economy grew by 3.2%. We're looking for 3.1% and then 3.2% for next year. So not really much movement. And actually 3% is pretty strong for the global economy. But when you look beneath the surface, there's a lot of diversity in terms of which economies are going to be driving growth. And certainly when you look at emerging markets, they're going to be providing the greatest contributions, and those contributions are going to be the largest among Asian economies, including China, India, and the ASEAN nations. When it comes to advanced economies, they're going to be slower in terms of their growth, and a lot of it's basically because you only have the US growing pretty rapidly relative to these other advanced economies. But the story is still generally one of recovery for many economies from the pandemic. And certainly once interest rates continue to fall for some economies and start to fall for others, we should see that pick back up in real GDP growth for the global economy next year.
Are there particular economies that drive real GDP growth this year?
Yes. Again, it's China and India. They are going to be providing the biggest contributions. And among advanced economies, it's going to be the US. So certainly emerging markets do grow faster than advanced economies because it's called catch up. So, and also the composition of growth is different. With advanced economies, the composition of growth tends to be more around consumer spending rather than investing in big industrial projects or lots of government spending on those types of things. So that's just why their growth rates are higher and their contributions are going to be bigger. But certainly we do have some concerns about China, even though they are probably going to provide the biggest contribution to global real GDP growth. There's still a lot of issues underneath the surface.
Looking at some of the more specific regions, are we seeing a K-shaped expansion in Europe?
I would say yes. And it's interesting. We just received the European data today, flash estimates for GDP, and it's still the case that Southern Europe is really driving a lot of the expansion this year. But also France had a really strong reading and has been having strong readings, and also the very northern parts of Europe. But you would expect that Germany and the UK, which are probably the largest economies, would be driving a lot of that growth, but it's not the case. So certainly Germany did have a setback in terms of GDP growth in the second quarter, which was negative on a quarter-on-quarter basis. And we know the UK continues to struggle with the fallout from Brexit, as well as very elevated inflation. So we're definitely seeing kind of this multipolar economy in Europe. But the good news is that euro area growth in the second quarter expanded by 0.3% quarter on quarter, and that matches the first quarter. So we're seeing very good growth overall in the euro area, and also for Europe, but we're still seeing that weakness in Germany and the UK.
Zooming into the US, what is your outlook for the US economy this year?
Yes, we had been calling for weakness in the middle of the year and then a pickup towards the end. But we had a surprising second quarter GDP growth outcome, where we saw growth expand by 2.8% on a seasonally adjusted quarterly annualized basis. What drove that was really the fact that goods consumption flipped from negative to positive, and so did inventory. So those two things really drove growth, as well as some strengthening in the contribution from government, again reflecting a number of policies that were passed to bolster investments in infrastructure, factories, chips, tech, that sort of thing. But like I mentioned earlier, spending on services did shrink somewhat, and we still had a big drag from net exports, mainly because exports rose, but imports rose even faster, so that's a negative. And also, you didn't have any real contribution from residential investment. And also, we did see a surprise pop in CapEx spending on transportation, but not anywhere else. So really a mixed picture. So that makes it difficult to see, well, what's going to happen going forward? Well, we still think that the economy is probably going to grow around 2.5% for the full year, maybe a little bit stronger. But most of that's going to come from the positive momentum we had starting the year, this really great second quarter GDP growth rate. But over the next half of the year, we do expect that consumer spending is probably going to continue to ratchet down. Again, given the factors that we mentioned, mainly the fact that the Fed is going to keep interest rates pretty high, even if they cut rates by anywhere from 25 to 50 basis points before the year is over, you're still looking at a 5% federal funds rate. So we think that consumers are going to dial down. We don't think that businesses are really going to get into the game until the cost of capital falls, again, related to interest rates. But we're still going to see a lot of volatility, I think, with respect to trade and inventories. There is some hope for residential investment. As I mentioned, once the Fed signals that interest rates are going to be cut, mortgage rates will respond before the actual cut, and that should help that market out.
You already mentioned China as a big contributor to global GDP growth. What is our outlook there for the rest of the year?
So our outlook is that the Chinese economy will expand pretty close to the 5% target that the Chinese government has set. And really, you just need growth to the economy to grow on average about 4.9% between the second quarter and the fourth quarter. So we do have second quarter data. It was, I think, 4.6% year-on-year growth. So that's pretty close. So we're probably going to reach that 5%. But it's a little, I would say that it's a little deceiving when you look under the surface. So what's really driving growth in China? Well, number one, China is still seeing very strong growth in exports. And relatedly, there's a lot of investment in certain sectors, especially sectors related to the greening of the global economy. So that's batteries and solar, EVs. But away from that, there's still a lot of weakness. Consumer demand is still in the basement. It's in the doldrums. And that is linked to the fact that China has this continuing weakness in the residential investment sector. There's a major housing crisis. It's not improving, and that's weighing on consumer confidence because many consumers have actually lost wealth because the value of their homes have fallen off. And meanwhile, you typically have the local governments come to the rescue with infrastructure projects and investments in residential investment, and that's just not happening. So there's still this weakness in terms of domestic demand with respect to the consumer and housing, and also the provincial governments. But you're getting a lot of stimulus from, again, government interventions in terms of investing in these high priority sectors, as well as some fiscal policy that was delivered earlier this year, as well as a minor reduction in the policy rate. But still in all, Chinese officials are signaling that there's going to be more stimulus for the economy such that it can actually achieve that 5% growth rate this year. We'll probably find more about that at the third plenum. But for now, we still have that forecast, but again, it's prefaced on more stimulus from the federal government for the economy.
Now, that was a great take on global growth. What is your view on the continued slowdown in global inflation? Can we continue to expect that will happen?
Yes, for the most part, we will continue to see slowing in inflation across the world. In some economies, especially in Latin America, inflation has already returned to the target ranges set by their central banks. And so some of them have already started cutting interest rates. And certainly we've seen throughout Europe that inflation has fallen quite materially. And we've had at least the ECB and also the Bank of England, as well as some other central banks, cut rates at least once this year and are signaling maybe another one. When it comes to the U.S., inflation is also improving. It's much lower than it was. Both the headline inflation for PCE is right around 2.5, 2.6%. But that's still above 2%, which is the Fed's target. And it's going to take a while for the Fed to get that inflation rate back to the 2% target. And the thing is that many economies, especially advanced economies, are still experiencing upward pressure on inflation that's making the journey back to target more glacial than what would be expected. One big issue is labor shortages. Many of these advanced economies are seeing their people retire, older workers retire, and hence a lot of companies are not finding the right types of workers and are having to bid up wages to not only attract talent, but also to retain talent. So that's putting upward pressure on inflation. And certainly there are other factors that are placing upward pressure on inflation, including energy prices and food prices. So those are resisting central banks' ability to get inflation back to their targets rapidly, but we do believe it's going to get there. And certainly we're looking for a number of central banks to continue to cut interest rates. Well, Markus, let me flip this question to you. You manage our central bank tracker globally. Which central banks do you think are going to continue to cut rates over the next few months, and which ones do you think will remain on hold?
Thanks, Dana. The rate cutting cycle in the developed world is sort of slowly gathering pace. I think a lot of central bank watchers probably thought there would be more impetus behind it this year, but inflation has been more persistent, not just in the US, but in many other parts of the world. And I think that resulted in sort of this slow trickle of rate cuts that we've seen so far. Of the 12 developed world central banks that we track on a regular basis, 4 are cutting rates, so just a third. And we're waiting for the Federal Reserve, the most important one, which seemingly may be getting ready. We probably hear more about it this week, to start that process in September. But even in the US, I think the process will be slow. We will not see a sequence of rate cuts. It will be just a slow process as central banks still try to get enough confidence that inflation can be durably held around that elusive 2% target. There are only 3 central banks in the developed world that are at target right now, which is Sweden, Switzerland, both of which have already started cutting rates, and the UK, but the Bank of England has not started to cut rates yet. So there is a bit of pressure building up in some central banks to start the process. The Bank of England probably the most prominent one with the highest level of real interest rates, which is nominal interest rates minus the inflation rate. But the US is also on that list, and New Zealand is another one. So I think it will be continued to be a slow trickle of rate cuts. But I would not be surprised if by the end of the year the majority of the central banks that we follow will be cutting rates, with, of course, a few exceptions, like the Bank of Japan, which is on a very different kind of monetary policy cycle. They were looking for rate increases, not rate cuts, but that's an exception to the broader market rule.
Yeah, and I would also add that for the U.S., our official forecast for the Fed funds rate is for it to start falling late this year. But we're going to listen to what the Fed has to say this week and also keep watching inflation gauges. If we continue to see progress in terms of inflation gauges slowing, the labor market holding up, and slowing in GDP growth and not really outsized growth, then certainly the Fed could start looking at cutting rates maybe in September. But again, we need more information both from the data and also from the Fed, and we'll see what happens.
Those lower interest rates, I assume, will be quite helpful to overall global growth. How much do you think that will be a contributor to growth, not this year, but probably in 2025?
I think it's going to be a material contributor. Even though our global forecast ticks up from 3.1 to 3.2%, again, it's the composition where you'll have a number of economies that have been under a lot of pressure from inflation, seeing relief from the inflation itself, and then also the added relief of central banks cutting interest rates, which can help stoke some domestic demand. But central banks, as you said, Marcus, are going to be very careful because they don't want a resurgence of inflation, and then they'd have to stop what they're doing in terms of cutting rates and either leave rates unchanged for a long period of time or even raise rates again. So central banks are going to be very cautious. But I do think that those two elements of lower inflation and somewhat lower interest rates will be beneficial for many economies.
That was a great walk through the details of the U.S. Consumer Confidence Index, plus our outlook for the global economy, with a few comments on how we see inflation and monetary policy develop over the rest of the year. Thank you very much, Dana, for joining us today.
Thank you, Marcus. It's always a pleasure.
And thanks for all of you for listening to C-Suite Perspectives. I'm Markus Schomer, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.